So I was right.
Yeah.
Cool.
Okay, makes sense?
No.
No?
I mean, don't bother explaining it to me. It'll take a little while. So.
You understand that nobody will ever say he's a knave?
Okay.
Right? Because a knave will say he's a knight because he has to lie, right? He has to lie. Because knaves lie. And a knight will say he's a knight because he will tell the truth.
Okay.
Right? So there is no possible situation that you're going to ask someone and he will say, I'm a knave.
Okay.
Because neither the knight nor the knave will say that. Right? So it is not possible that somebody says it. Right? Make sense?
Yeah.
So if B said that someone said they were a knave, which wouldn't be the case, B must be lying about what the other.
Right? So he must be lying because nobody would have said that he is a knave. Like, there is no
Yeah.
possible guy who would have said that. All right. Okay, are we good with that? Okay, now in a similar vein, let me give you another puzzle to think about. Again, we're on the island of knights and knaves, so we're looking at 3 inhabitants, and we're asking them some questions. This time, there's like a different situation. See if you can figure it out. Got a couple of minutes. Yes.
The knights are liars or the knaves?
Yeah, the knights are telling the truth, and the knaves are always lying. Right, so the key is that the knaves always lie. Right? They don't just choose to sometimes lie. Right? The knaves always have to lie, and the knights always have to tell the truth. Right? That's the framework. Give it a think, talk about it, and I'll do that.
It's the same thing. Right?
So, are we ready to move along? Or we can diagramming out some possibilities. All right. Okay, well, if you aren't ready, you have another couple of days to think about it before we discuss it on Thursday. All right. So last time we were discussing the idea of compound interest and how that translates into exponential growth. Right, now, before we continue digging a little further into this idea, let's talk about our experiment playing Dominion. So raise your hand if you had a few rounds of the game and collected some data. Okay, raise your hand if you did not have a few rounds of the game.
And I was home all weekend, and every single time I tried on the computer, it just didn't work.
Well, maybe. I mean, we're going to discuss it, but hopefully you can find the computer, or you can just talk, talk with a few of your classmates and discuss it. Yeah.
That actually happened to me a few times. I had to, go out of the thing completely, shut down my computer, turn it back on, and go back in, and eventually it worked.
Okay, that's not very encouraging. Like I tried it several times myself and never had a problem. So I don't know. I guess.
I won my first round last
Nice.
night. I was really happy.
All right, how many of you managed to win around the Dominion? Okay, good stuff. Do you all play against the computer or against each other?
Both.
Both? Okay. All right. So let's look at some data. Though. What is approximately the average length of the game in rounds? Right, a round is when everybody has a turn going around the table. Right?
Yep.
Okay, so I mean, about 20 to a couple dozen turns seems to be like the average length of the game, right? And you might know after you play the game, there is a game summary link, and it gives you like text output of all the actions everybody took and everything that happened, right? You guys notice that? So you didn't actually have to count. Because after the game, you just click it, and you just say at the end it will say round 24, like game over. And you say, oh, 24 rounds. Okay. All right, I guess if you counted the rounds, that works too, but you did more work than you really had to. Okay. So basically, that gives you the idea of when to expect the game to terminate, right? You know that about 20 to 25 rounds, it's going to be over, right? Because the game terminating condition is that you run out of provinces, or 3 of the kingdom cards are gone, exhausted, right? Okay. Now, what seems to be the strategy for winning at the game? Like, what are your observations? Yes.
Like every chance you get, try and buy like one of the blue cards, like a duchy or like an estate or a thing. That's all I want. I just kept buying.
All right.
See, I found that you had to, at the beginning, start buying higher money coins. So if you had like 3 of the 1 coins, then you buy a silver, and then that would help you accumulate more money, and then buy a few attack cards or anti-attack cards. And then at the end, you start buying up as many of the providences and stuff as you can.
Okay. Anybody else have a Okay. Anyone else have any other successful strategies, or not so successful ones? Okay. All right. So the basic idea is that you have, a deck of cards that you're playing with, and every turn you start by drawing 5 cards and doing what the cards enable you to do. Right. So one thing you might have noticed is that your scoring cards, estates, duchies, and provinces, are basically useless in the middle of the game, right? You cannot do anything with them. So you draw 5 cards, you have some estates in there, like they don't do anything for you, right? They're just taking up space, right? They don't help you accumulate more stuff, but they're just kind of sitting there, they're dead weight. So in general, if you have too many deadweight cards in your hand as you're playing the game in the beginning, right, you have a harder time accumulating more resources. right? So now apparently if you just accumulate them every chance you get, sometimes it works out well, which is fine. But in general, it seems to be that the higher rate of success strategy would be that in the beginning you accumulate money so you can buy stuff, and you accumulate action cards so you can do stuff, and try to go light on the scoring cards until you know that the end of the game is approaching, right? The other issue is the issue of density, right? You notice that a province costs 8 coins and gives you 6 points, right? Whereas a duchy costs 5 coins and gives you 3 points, right? So the price per point, if you buy the bigger province, is a lot better than the price per point if you buy a duchy or an estate, which is even worse, right? The same thing at the same time, right? Imagine, like, let's say you have a province and gives you 6 points. If you're just getting estates, in order to get the same number of points, you have to have 6 estates. So these estates are going to be sitting there and cluttering up your deck. So when you draw, you're going to be getting a bunch of estates, and that's going to be helping you, right? The same thing, you want higher density of money. Because if you draw 5 cards and all you have is coppers, the maximum number of coins you will have is 5, right? Whereas if you have some gold and silver, you can increase the money stock in each turn and can afford to buy the higher density cards such as the provinces, right? In general, unless certain turns of events happened, or your strategy is to go for high frequency, you probably don't want to buy a bunch of estates because they're really not dense, they're not cost efficient, they're not space efficient, right? The game is not of a single, it's a complex game. There are many different things you can do, right? And so if you want to just shoot for a bunch of estates, and then apparently you can win successfully with that, it's great, variation in success strategies. Right, but now let's think about think back to asset returns and real life and things like that. Right, you don't want to accumulate deadweight assets that don't do anything for you, right? So you want to have some assets for immediate consumption because we need to live and eat and do other stuff, right? But you don't want to accumulate too many of those inert assets that are not generating returns for the future, right? So, also a lot of people, think that maybe like a car is an asset. The car is not really an asset. It doesn't generate a return, right? It is an expense. You buy a car, it just sits there, it depreciates. It takes gasoline, it takes maintenance, etc. Now, that's not to say you don't need a car. You need a car to facilitate your other productive activities, right? But by itself, right, it is not an investment. It is an expense, allowing you to do other stuff, right? And, to an extent, the same can be said for a house. Now, housing prices historically have appreciated, and so to a certain extent, a house would serve both as a, domicile and some kind of a return-generating asset, right? But in general, you don't. Unless you're in the business of real estate, you don't buy a house as to make money. You buy a house because you need to live somewhere, right? The same. Think of a lot of things as: is this an expense, or is this an investment asset, right? And generally, you want, for the longer term, you will be better off the more investment assets that you have and the fewer expense assets that you have, right? Now, you need expense assets to facilitate other stuff. I'm not saying you don't need this other stuff, but I'm just saying, just think about, you want to minimize the outflows and maximize future inflows, right? Because that's how you end up better off at the end. Right? Make sense? So, you think this, Dominion exercise was interesting and somewhat useful? Did you think about this stuff, or not so much? fine with it? All right. Okay. So, now last time we talked about asset returns and exponential growth. So let's continue our discussion to that effect. So, okay. So we discussed that in general, if you have some kind of a rate of return, right, then from one period to the next, we're going to be growing by a factor of 1 plus the rate, right? So in our example, when we were growing at 10%, right, we started with some amount in the beginning, at the start, and then well, if I'm getting 10%, I'm going to end up with my principal plus whatever percentage growth I get, right? And that will be my final amount at the end of the year. And then we'll repeat, and we'll grow again by a factor of 1 plus the rate, right? And so in general, we can write down a simple relationship to calculate what would be the value of our investment given that fixed rate of return over some number of periods, right? And we did that a number of times, looking at the potential future value of some amount of money that would be IRA and things like that, right? Now the general equation for the relationship between initial and final value is, as you can see over here, the present value, which is the initial value, times 1 plus the rate, raised to the number of periods, right? And that gives us the future value, right? Everybody with us so far? And we recall that, this was our framework from last time. Any questions? Anybody? Okay. Right. So, given some starting conditions and some rate and the number of years or periods, etc., and what periods we wait, we can figure out how much we have at the end. Right. Now, this is thinking back to your algebra days, right? This is one equation with 4 variables. So theoretically, given any 3 of these, we can figure out the 4th, right? Because we have one equation and one unknown, and solve for the missing value, right? So we don't have to say, well, I'm putting in $1,000 today, how much will I have in so many years, etc. We can answer other questions, such as, I want to have $1 million in 50 years. Right? How much do I need to put in today if I can expect to grow at 10% in order to achieve my $1 million? Right? So we're basically asking for, we know the rate, we know the time period, and we know how much we're aiming for, and we're looking to find how much we need to put in today in order to get there. Right? Now that's an interesting question to ask, right? You might want to know what that is. So how would we solve for the initial value? You want to propose something? Yes. I'll buy that, right? Let's divide both sides by 1 plus r to the t. Right, so we'll cancel out here on the left, and we end up with that on the other side. Right? So let's imagine we do have this hypothetical problem. We want $1 million in 50 years at 10% interest rate. How much do we need to put in today in order to get that? Assuming we don't put in any more money, right? We're putting in that one amount. Just you're going to first try to think intuitively, how much would that have to be? Right? Do you have an idea? What do you think? Hmm?
Can you repeat those numbers?
50 years. This is $1 million that we want in the future. We have 50 years to go, and we're getting a 10% rate of return. All right, so what do you think? Give me your ballpark amount. How much? You said 5,000. Anybody else? No? No ballpark figures? You're all too busy. It's why did you want to guess 10,000? It seems reasonable. Now you might recall that last time $1,000 growing at 10% per year gave us 117,000. So if we put in 10,000, we're going to get 10 times as much. We'll get 1,170,000. Right? So 10,000 is actually a pretty good ballpark estimate, right? If 1,000 produces about 100,000, then 10,000 will produce 100,000. Right? So it's a pretty good guess. Now, it will be a little bit less, right? Because 10,000 will produce 1.17 million. So what do we have? You guys have a result. Right? So not bad at all, right? We almost scrounged up that much money somewhere. Right? But in general, like it's not like a world-shattering, crazy figure that you need to come up with today if you were willing to wait for 50 years, assuming you get it out. Right? Okay. Now, another portion we might ask is, I'm putting in, $5,000 a day. I want to have $1 million in 50 years. What must be the average annual rate of return that I get in order for that to happen, right? So in that case, we would be solving for the rate that we want to earn every year, right? In order for our, say, $5,000 to grow to, say, $1 million in 50 years. And if you figure out what would be the rate that will produce $2 million starting from that, right? So let's first look. Let's first look at it symbolically, right? What are we going to do when we try and solve for the rate? Let's do it. So let's do it step by step, right? And actually, you make it more complicated than it has to be. So first, we're dividing by the present value, right? We're going to zero in on the starting side of the equation. So we're going to have 1 plus r to t on the left, and t value, present value on the right. Right? Now, what's the next step? Right? We want to sort of get inside the parentheses. So you said, let's take the log of both sides, right? What is that going to do? Okay. All right. Then we divide by t, and then we still have to get inside the parentheses. Oh, so taking the log and then exponentiating again, like we're undoing it back. Like, do we really need to do that? Like, we're taking log and then we're exponentiating it back to get rid of it. Okay, I mean, whatever works, but what do you think? I like that. I just raise both sides to the power of 1 over t, and our exponent, t 1 over 2 will cancel out and get rid of it without any. Now keep your logs in mind because we're going to use them when we solve for t. But for the purposes of solving for the rate, we don't need to deal with log. We can raise it to the power that we cancel out. Right? Now, is everybody with us? Yeah? Do you remember the rules of exponentiation? Okay. Alright, so what we're going to do is we're going to raise both sides to the power 1 over t. 1 over t is just some number, right? We should be able to raise to any power. So when we do that, we'll have 1 plus the raise to t to the 1 over t. Alright? And on the right, we'll have future value over present value. Also to the 1 over t. Alright, now you remember that x raised to the a raised to the b is the same thing as x raised to the a times b. Right? That's the rule of exponentiation. That's the power of b. So what that means that 1 plus r to the t to the 1 over t is 1 plus r to the t times 1 over t. Alright, what's t times 1 over t? 1, right? So basically, we're going to do 1. Okay? So what we end up with then is we have 1 plus r is equal to future over present to the 1 over t. Right? And there we are. We can subtract 1 and solve. Right? A little simpler. Although, if we don't make any errors, we should end up exactly in the same place, which is fine. So all right. Anyone have any questions? Do we follow this process? We fine with that? Maybe. Yeah. All right. So now we can, answer the question of what interest rate must we earn if we are starting with, say, 5,000 and we're going to 1 million over 50 years, right? And just plug in what we know. We know the final value we want. We know the initial value. We know the number of periods. We can solve for the rate. So give it a try. Now, first of all, take a guess. What would the rate have to be? Why 12? All right, excellent reasoning, right? Basically, if it takes 10% to get from 8 to 1 million, and to get from 5 to 1 million, you need a higher rate, right? Because it's starting from a lower amount. So you know that you're expecting something more than 10%. I don't know how much more, but a little more. So, all right, everybody understand what we're talking about? Okay. Now, does anybody have an actual rate? Yeah. 11 point something. All right. Right. Okay, makes sense. So, I mean, again, this is, just sort of throwing down the basics of playing with the single lump sum present value, future value, so we can kind of get an idea of how these things fit together. And what are the demands, right? All right, so now the final thing we might want to ask is, let's say I'm putting in, $5,000, and let's say I'm getting 10%. how long will it take me to get to $1 million? Right? So in this case, we're asking, what is the t in this equation? Right? Because we know the initial value, we know the final value, we know the interest rate that we expect. We want to know how long will it take for it to go to $1 million. Right? So before we do that, let us solve the equation for the opponent. And so let's just stick with this. And so one for right? This form. And now we want to isolate t on one side of the equation. Right? Now you get to pull out your favorite trick. What are we going to do? All right, let's take the log of both sides. Now, before we do that, let me remind you, right, that the log of x to the a is equal to a times the log of x. Right? This is where, if you understand what a logarithm means, right, it's the power 2 which we must raise the base to get the operon, you will see, and if you think about it, that this is, this is how we call that. Right? If you take the log of something to some power, because you pull it back down to the rule of exponentiation there, right? We get the product of the exponent with the base. All right, so when we take the log of both sides, what we end up with is the log of 1 plus r multiplied by t, right? We take this, and that. And that is equal to the log of integer over this. Right? Any questions? Are you with me? Maybe? Yeah. No, just go with this. We take the natural log of both sides, right? Whatever we do an equation, we have to do the same thing to both sides in order for it to remain the valid equation, right? Okay, and what's our last step to isolate t? That's right, right? Divide the log of 1 plus r, and we end up with t is the log of 6 divided by the log of 1 plus r. And there you have it. Right? And so now we can answer questions like, let's imagine that we're starting with 5,000, we're getting 10% interest rate. We want to get $1 million. How long will it take? Right? Now take a guess. Approximately how long will it take? I guess I'll get to the easy question. It's going to be more or less than 50 years. It's going to be more than 50 years, because remember, in order to get there in 50, we had to get 11 point something percent. Now we're getting only 10, so it will take us longer to reach the same value. Give it, give it a run through your calculator and see what you get.
55.5 million for 3 years.
Okay? Everybody with us? Are we fine with basically doing these kinds of mathematical manipulations to figure out the various bits? Okay? Good stuff, right? So this is, it's pretty straightforward if you haven't forgotten your mathematics, which I guess some of you may have. It's fine if you don't do it, but you have an excuse to do it. Right? So this gives us some simple, easy, quick ways to figure out the different bits. Now remember that with the advent of computers, we don't really need to do all this stuff. Any of this stuff, you can solve it by trial and error, as long as we know the relationship between the variables, right? So for example, let's let's say, where we don't know how to solve equations. And we just know that we take an initial value, multiply by 1 divided by 2, you get the final value. Right? We can solve for any of these variables by trial and error, right? Trial and error is always a valid method of solving equations if you have the time or the computer ability to do that. Right? So for example, say, well, how long will it take to get to 1 million? Well, just tweak the t a little bit until you reach about $1 million. Right? And you will find that if you tweak the t up to 55.59 or so, you'll get you really close to 3 million. Right? Or what interest rate must I earn? Well, tweak the rate a little bit until you get to whatever target you get. Right? Just keep in mind that we're doing all this fancy stuff, and we give us a nice, simple, like plug it in to get the answer pops out. At the end of the day, what we're basically trying to do is figure out the root. We're trying to figure out what is this value that produces it, and we can do it by trial and error as well, right? So if you understand that the higher the rate is, the higher the final value will be. Everything else being equal, right? The bigger and longer the time that you wait, the higher the final value will be, right? You understand that your explanation, you can tweak it until you get to where you need to be. Right? Any questions? This making sense? Okay. Now, we talked about single, basically a single starting value and single final value. Now, as it happens, it is often the case that we have multiple cash flows happening throughout the period. Like if we talk about maybe our IRA, we could say maybe I'm putting in $5,000 every year, right? I don't know what that will matter to him. Or maybe, you say I have $1 million and it's earning me about 10%. If I start taking out $5,000 every year, how long, how many times can I do that before I run out of money? Right? And there is in general, in finance, it's called an annuity, where you take out or put in a fixed amount every period of regular. Right? Have you guys heard this J.G. Wentworth commercial? I have a structured settlement and I need cash now, right? And somebody else said, I have an annuity and I need cash now. That was the annuity, right? So basically, in a structured settlement or an annuity, it says, we will give you some kind of payment amount over time, right? So this guy has a claim on some stream of future cash flows, right? And he says, okay, I have this claim on the stream of cash flows, but I want more cash now. What can I do, right? Now, this stream of future cash flows has some value, right? It's valuable to have a claim on receiving some kind of stream of cash flows, right? So, these companies, they have, the company's business is to basically, the guy is going to give them the right to receive these future cash flows in exchange for some amount of lump sum cash today, right? So, how do they figure out how much cash are they willing to give you in exchange for, say, 30-year annuity of like $5,000 a year? How would you figure it? Let's say I have an annuity, 30 years, $5,000 a year, and I need cash now. No. All right. How much are you going to pay for it? $1 million. Why is that? Because you need the money to come in. Well, of course. Let's imagine that it's like you and then there's like some other guy and some other guy, and they're all competing to get a good deal. Right? Why do you think you can get away paying a third? Like the next guy's going to say, hey, wait a second, don't take a third. I'll give you 34%. Right? Are you going to say, okay, I'll beat that and I'll give you 35%? Are you?
It all depends, probably.
Okay, and then you say, okay, I'll give you 35. The other guy comes in and says, you know what? I'll give you 36%. Are you still gonna deal?
I'm not in business, I don't know.
I mean, I'm just saying, right? So the question is not, what is the awesomest deal you can come up with for yourself, right? Because we can all come up with an awesome deal, like, yeah, I'll give you $1 for it, right? The question is, what is the maximum you would be willing to pay, right? That's the difficult question, right? And then a third, yeah, sounds like a good idea, right? But is it a fair price? Is it more a competitive price, right? That's the question. So I mean, I appreciate you throw out a number. It's good, we have a talk. There's nothing wrong with that. It's good stuff. But the question is not, what sounds like a good deal, but what is the maximum you would be willing to pay? That is the tough question that we have to answer, right? But in a competitive marketplace, that's the thing. I'm going to be meeting with other guys. They have, they want a good deal also. So what is the maximum I'm willing to pay and still get a good deal, right? Yeah. Well, you don't get to keep the interest, right? You don't receive these values right away, right? So you pay them some money now, and in exchange you're going to receive $1,000 a year for 30 years, right? So you don't get to take that money and invest it right now because you haven't gotten it yet. Okay. Right, so just to be clear, right? It's not that you suddenly get all that cash, right? The other guy who traded it to you gets your cash, but you have to wait for his cash. Right? That's the whole trade-off. Okay. So one question I'm asked is this, right? So let's say I promise to give you $1,000 in 1 year, right? Now, how much are you willing to pay me in exchange for this promise? Right, for example, like let's say you give me $10 right now, I'll give you $1,000 in a year. It sounds like a good deal, doesn't it? I mean, I assume I don't want to die or run off. Pretend I'm 30. Right? So I can have, so how much so $1,000 in 1 year, how much seems like a reasonable amount to pay for the right to receive $1,000 in 1 year? Assuming there is no need to talk. It's a gut feeling question. What's your gut feeling? How much are you willing to pay for the right to receive? Let's have an auction. $1,000 in 1 year from trustworthy old me. Bidding starting at $100. Do I have an offer? Okay, I have 100. Do I have something more? Yes. 200. Anybody else? I got 200 for $1,000 in 1 year. Anybody else? 205. Okay. 250. Okay. I got 250. I got 250. Do I have something more? Do I have 300? 300. Do I have 300?
5.
Hmm?
5.
500? Okay, I got 500 from the generous gentleman over there. Do I have anything more? Do I have 550? 550? Do I hear 550? 501. Okay. 550. We got 550. All right. Do I hear 600? 600. Do I hear 600? Maybe 551. What? Anybody? All right. I have 600. 600. Do I hear something more? Do I hear 650? Maybe 601. Anybody? 650. Okay, I got 650. 650. Remember to assume that you know that you will receive it if you bid it, right? So there's no risk that I'm going to die, get hit by a bus and not give you $1,000. Let's say I have contracted with an attorney and I can give him the contract. If anything happens, you will still get it, right? All right. Do I have 600 or that or 650? 650. 650. Do I hear anything more? 650. 700. Okay. All right. I have 700. 700. 750. All right, all right. Well, 800.
Yeah.
Okay, I have 800. Do I hear anything else? Is anybody else? It's $1,000. 850. 850. Okay. All right. Do I hear something more? Do I have 900? 900. Maybe 851. Anybody? 850. 850.
$900.
900.
Or
Okay.
more than. That's more interesting than
10% on 900 is $1,000. So you get 990 now. Just to the side while you mention it. All right, so 900. I have 900. I have 900. For a risk-free offer to receive $1,000 in 1 year, I have 900. Do I hear anything else? Anything? 910. Okay, 910. Anybody else?
$50 is nothing.
Well, you know, $10 is fine, right? I mean, as long as we don't get down to sub-dollar increments. All right, 910. Do I hear anything more? 910.
Yeah, I mean, that's still more interest than I would get in any other format. That's still almost 10% interest. Realistically, I'm not going to do that, so I'll take that.
Well, so are you going to outbid? Do you have a bid?
What is this for? Like, I don't.
We've been having an auction.
Well,
Okay,
no, I
so it's
say
like, you know, there is a contract that says, you know, if you buy this, you will receive $1,000 in 1 year, right? So the question is, how much are you willing to pay for the right to receive $1,000 in 1 year, right?
So like, if you paid less than the time,
Yes, I mean, probably you don't want to pay $1,000, but I don't know. Right?
why would you be selling?
Why not? Think of it as, you know, think of it as a loan. What is a loan? You give me some money now, and then I give you some money back, right? Hopefully a higher amount. Otherwise, you can't get right? So that's what the loan is. Like, you give some money now, you receive some money later. And you're saying, well, how much am I willing to give you in exchange for receiving that some money later? Right? It's the same thing. Right? Just, you know, put it in different terms. Right? Make sense? So I'm saying I'm promising to give you $1,000 in 1 year. How much money are you going to give me today in exchange? So I have 910. Do I hear 920? Okay, we have 920. Anybody else? Do I hear 930? Anybody? Do I hear 921? All right. So, you know, the point, that's fine. You know, you just got it for 920. All right. So the point is, right, number one is that you can say, I want it for $100. But you're probably not going to get it for $100 because somebody else will be going to pay more. All right. So you're only going to get the claim on these cash flows if you're willing to pay a competitive price that nobody else is willing to beat. Right? So in our little auction experiment here, I sold $1,000 in 1 year in exchange for $920 today. Right? Now we can think, what is the rate of return on this investment? Right? So what is the rate of return? Our initial starting value is 920. So you're putting in 920 today. And you're going to get 1,000 in 1 year. So what is your rate of return on this investment?
About 8.5%.
Seems about reasonable. Calculating that. Is that new?
It's 0.086956.
Right? Now that's not a bad interest rate, given the assumption that this is a risk-free proposition. There's no deposit. Where else do you go and put money to today and like get 8.6% with bearing no risk. Nowhere, that's where, right? So if we had an actual competitive marketplace for this outstanding contract to be $200,000 in the future, assuming that it wasn't indeed everybody looked at the terms and understood that it wasn't indeed risk-free, what do you think would be the competitive market price or competitive market interest rate on this asset? What's the current risk-free interest rate that you can get somewhere over the course of the year? You have any ideas of what the current interest rates are? If you're getting 0.05, you're getting shafted. It's actually
0.5%.
Right. It's closer to about 1%, right? If you get a bank CD, you could get about 1% on a 1-year CD, right? Maybe 0.9, like about 1%, right? You can get 0.05 in a savings account in Wells Fargo, right? But a savings account in Wells Fargo is not an investment vehicle. It's just a place to stash your money because you might need it soon, right? As we discussed, you don't put money in the bank because you're investing it. Using a CD isn't really a good long-term investment, but we're talking relatively short-term. We're talking about risk-free interest rate, so we'll take it, right? So 1%. So that means that everybody's saying, okay, what can I do with my money? Over the, if I need a risk-free investment over a term of 1 year, what are my alternatives, right? I can go and put it in a bank CD and I can get 1%. If I go put it in government treasury, I'll get less, right? So I have a choice. Do I put it over here at 1%, or do I put it over here at 1.5%? Still sounds pretty good, right? To put it over here at 1%, to put it over here at 1.2%. Sounds pretty good, right? So in a competitive marketplace where we have people, thinking, where do I put my money to get the most return given the parameters, right? The price is going to converge to what the market interest rate is, right? So you can see that when somebody is saying, would I prefer to get 8.69% versus 1%? They'll say, hell yeah, 8.69, right? So they're going to bid, 930, and somebody else will say, well, that's still like 7%. Hell yeah, I'm bidding 940, right? And so the price is going to increase until we get something on the order of like 990, which gives us slightly more than 1%. Right? And then people say, okay, I'm indifferent, I don't care now. Right? Make sense? Any questions about the framework and what we're talking about? Anybody?
So how do people that are loaning their money, how do the people that are paying back the paying back, they're losing to the person they're paying back to the paying? Like if they're only getting $999 in a year, they're gonna have to pay the person back $1,000.
Well, they would only take out the loan if they have some kind of an investment proposition where they can make you good money. For example, why do you think the bank pays you 1% interest rate if you're lucky? If you know where to get a good interest rate, why do you think they're paying you say 1% interest rate? Right, you're only giving them 1,000, and then in 1 year they have to give you 1,000 in tip. Where are they going to get that? Right? They are saying, we're going to take your money, we're going to give you 1%, but we're going to make 5%. So we give you 1%, we still have 4% left over. We just made a bunch of free money. Woo-hoo. Right? So how do banks make money? They make loans. Right? So for example, they pay you 1%. Like a commercial business loan will run maybe 5% or 7%. They take your money at 1, they lend it out at 5 or 6 or 7 or 10, or they're on your credit card or scheme, right? And so at the end of the year, they come back and give you one and keep the rest. All right, so hypothetically, I mean, this was just a hypothetical, I promise you $2,000. But if, let's say I wouldn't do it just for the hell of it, right? I would do that if, say, I had some kind of a project that needed financing and needed money. And I thought, if I can do that, my expected value is, I expect to get a 10% rate of return, right? And then I would go around and try raising money to finance the project if I didn't have money, right? I mean, this is how companies do it all the time. A lot of, when you look at stocks and bonds, this is companies attempt to raise money. They issue these contracts with certain, which are kind of like promissory notes for certain cash flows in the future, or maybe not so certain cash flows. Right? And we'll, at some point later on in this course, we'll talk about the poverty of stocks and bonds in general, right? And so, I mean, the reason they sell them is because they want money to finance their operations. Right? They think we have these profitable opportunities, we need to take advantage of them, but it takes like $100 million to invest in this opportunity. We're going to just raise money, raise capital, right? So so that's the way it works, right? Like somebody is there are two possibilities. Possibility number one is that they have a project that they think is going to be more profitable in the future, they will pay them money. Possibility number two, there is camera and they want to run their money. But both are possible, but I'm just saying, there's nobody going to do this just because I plan to take your 990, stick it in my mattress for a year, and then give you back $1,000. Nobody plans to do that, right? They're planning to use the money to generate the return. And hopefully they succeed. If they don't, maybe they'll default. Okay?
Excellent question.
Anybody else have any other issues you want to talk about? Okay. So, so this is the actual, actual mechanics of raising capital. I mean, in general, we'll probably discuss about the structure of exchange markets and markets in general, which are in effect based on the type of options. But for now, let's just come back to our present value, future value relationship. All right? So how do people decide how much they're willing to bid for particular future cash flow? All right? The way they decide is they're going to say, well, what other opportunities are there of similar riskiness and what returns do they generate? Right? So, for example, here we assume that this is a risk-free proposition, and they said, well, let's compare what other interest rates we can get in a risk-free manner. We say, oh, it looks like I can get about 1% risk-free out of there. So they're going to say, the maximum I'm willing to pay is going to be the amount that will generate at least what I can get elsewhere. Right? Because you wouldn't pay so much that you get less than what you can get elsewhere. And you just put your money somewhere else and get more. Right? So let's imagine that we are looking at $1,000 in 1 year, right? Here's times 0, here's times 1, right? And want to know what is the maximum I should be willing to pay. Now I look around in the marketplace and I see that the best 1 year risk-free interest rate I can get is 1%. So what is the maximum I should be willing to pay for the right to receive this $1,000 in 1 year? Would be the amount that when you invested at 1% gives us $1,000, right? So what is that amount? I bet we can use an equation that right? Hmm? 9.95. Right? Anybody can confirm that? Right, so how did we find that? Right? We just use this framework right here. We're looking for the amount of money we need to put in today that will grow at 1% to $1,000. Right? So we're rearranging this to solve for the initial value, right? The certain value. And so we get that 1,000 over 1.01 first, over 1 year investment, right? And it happens to produce 99 Right, so if you're looking at this alternative, you know that you do not want to pay more than 990.1. And probably you will pay just slightly a little bit less, whatever, depending on how widely available this opportunity is and how much competition there is for it, right? You definitely don't want to pay more than that, because you could say, why, if I pay more than that, I will get a rate of return that is less than 1%. And why would I want to do that when I can just go somewhere else and get the whole 1%? Right? So this brings us, to this concept of present value, right? The present value of future cash flows, right? That is, how much am I willing to pay today for the right to receive certain cash flows in the future? And the way we figure out how much we're going to pay today is by looking at what is the next best alternative investment, right? Now, certain investments may be risky, right? You had a risk, I said, risk-free $1,000. Now, certain investments may have default risk or variability in the payout. And, risk is not an attractive feature, right? Because, again, sometimes you don't get your money back, or sometimes you get pennies on the dollar, and you want to get paid for the extra risk so that your expected value is still high, right? So in general, the higher the risk of investment, the higher the rate of return you would require on this investment. This is the reason that, for example, banks use the credit score as a determinant of the interest rate that they're going to charge you. If you have a high credit score, that signifies that you have a low probability of defaulting on your obligations. Right? So if you have a low probability of default, there is not a lot of risk in the loan, so they're willing to give you a lower interest rate. Because again, because they know that out of 1 million people with a high credit score, maybe like, 0.1% are going to default, right? So that their net take at the end of the day is still going to be pretty good. But out of 1 million people with a low credit score, like 30% are going to default, right? So if they, if they still charge them a low rate, then on average their return is going to be like negative. If you're a bank, you don't want that. So you'll say, you know what, you guys with a low credit score, I'll charge you like a 10% rate or 15% rate. So it'll be hefty. So even after 30% of the people default, and on average maybe they get to collect like 10 cents on the dollar, at the end of the day, they average it out and say, hey, we still made 5%. Awesome. Right? They didn't. They're not going to make a whole 15 because they know there's going to be default. They're going to be losing some money. But if they charge a high enough rate, then on average, given the statistical regularities of default risks, they're expecting to still make money, right? So the same thing goes with general investments. If you look at corporate bonds, they have bond ratings. Now, bond ratings are kind of like FICO scores, right? Like credit scores, because bond ratings are correlated with the probability of default. So if a firm is in bad financial shape, they have a lot of liabilities, and have low cash flows, then the analysts are going to look at it and say, you know what, it looks like there's a pretty high probability that these guys are going to go belly up, and the creditors are going to get screwed. So I'm going to give them a low bond rating, right? Or they look at another company, like you look at Microsoft. They're sitting on wads and wads of cash, and they're like, they don't know where to put it. They're just like swimming in cash. So if Microsoft wants to borrow a couple $1 million, well, they're going to have a pretty damn high credit rating, high bond rating, because there is a very low chance that they're going to default, because they're just like swimming in gobs of cash, right? So like even if they don't sell any more Windows software for the next 10 years. They'll still have so much cash that they'll be able to repay all their loans, right? Make sense? Okay? So, for example, we can, if you want to look at the hypothetical numerical example, let's imagine that you are Billy the loan shark, right? And so you say, okay, I have a bunch of these people coming, coming to get loans, but I know a bunch of them are like deadbeats, and even when I send Vinny to the enforcer or the batch to try to keep money out of them, like half of them are not going to have any, and I'm going to incur some losses, right? So, and yet, I'm putting my, good old personal money on the line, loaning these people money, and I want to make a positive rate of return. So what interest rate must I charge on my loans in order to still make my desired rate of return on my money, right? So here you are, you're saying here, okay, so you're saying, okay, in this year, I will be making, say, 1,000 loans of $100 each, right? So loans to 1,000 people, right? So let's say, number of people, 1,000, loan amount, $100, right? So in total, I'm using, loan amount, so I'm putting up $1 million, right? And in total, at the end of the year, I want to produce a rate of return of, say, 8%. Nice and healthy rate of return. But looking at the historical properties of my clientele, I know that, say, 10% of them are just like, they're deadbeats and you're never going to see any of my money again, right? So default rate is 10%. So I want to know what interest rate must I charge on my loans in order to make 10% on average at the end of it all, right? Surely if I charge 8%, I'm not going to make 8% at the end because 10% of the people are deadbeats, right? And no matter how hard Vinny beats them with the bat, there's no money, right? And just you should right? So you're saying, like, here I am, I'm a businessman, I want to know what interest rate must I charge on my loan, give us information, in order to still make 10% on average. That's an important question, because if I charge too little, I'm going to lose money. If I charge too much, well, the profit will be nice for me, but I'll not be able to attract clients, right? Because people will go to competitive loan sharks and get a better rate. So I need to set a competitive rate. So what is the interest rate I must charge? Can we find what that interest rate is? So the answer is yes, we can. And now the next question is, how can we find what interest rate I must charge on my loans? I mean, there is some more, and we have to put in some more thought. We will have, a rate of return in there somewhere. We'll have that equation. But we need to know what is the rate in that equation that will produce 8%, given that we have a 10% default. All right. So what we need to do is we need to set up what we want to receive at the end of our money, and set it equal to what we will actually receive as a result of the interest rate that we charge. Right? So what do we want to receive at the end of the year? How much money in total do we want to get at the end of the year after all is said and done? $1,080,000, right? Because we're putting up $1 million. We want an 8% return. That means at the end we want $1,080,000. So 1.08 million is what we want at the end, right? Make sense? Now we're saying, how are we going to actually produce that rate of return? No? So before we go, how do we produce that rate of return? All right, that makes sense. Exactly, right? We're putting up 1 million. We're charging some interest rate that we don't know what it is, right? That we're looking for, but we're not going to get this whole thing. Because 10% of these guys are defaulters, right? They're dead. So we're only going to get 90% of them back as promised, and the other 10% are gone. Right, now you can model it more in a more complex way. You could say that for people who default, on average, I get 10 cents on the dollar. So then you would say, and then the other 10%, I get, 1 million times 10%, 10 cents per dollar. But you know, we're not going to do that right now. Simplify it, assume that you get 0 for something who defaults. And we can rearrange that, we can solve for what is the rate that we must charge, right? And so we're going to continue from here on Thursday. All right, so we said that our desired net return is 8%.